Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending May 14th, 2023. Appreciate you all tuning into this channel, subscribing, as well as subscribing to our podcast, InvestTalk. I'm Justin Klein, host of InvestTalk, and this week I'm going to title the video, Inflation is Dead. Markets turn to economic fallout. And really that's what the economic data for this week was. It was all about inflation. There wasn't a whole lot of economic growth type numbers, few, but nothing really of note. Nothing changed dramatically. But the CPI came in, the PPI came in, and we're going to go over that here. What you can see here is month over month consumer price index was up only 0.05%, 0.05%. Right, that last time it was that low was back in July of last year, and month over month on the core ticked down to 0.38%. On the year over year though, you can see consumer price index is now below 4.99, and the core, that one is month over month core is that's the PPI is negative. Yeah, so basically, you're below 5 on the consumer price index, and then the PPI month over month, that was negative. Year over year core on the PPI, that was 3.4. Yeah, you heard that right, 3.4. And you'll see here it continues to get better on the inflation front. The producer price index month over month, that came in at negative 0.5%, negative 0.5% month over month. Year over year, only 2.75. Yeah, that's a two handle on the producer price index year over year. Import prices year over year down 4.5%. Yeah, import prices, the cost to import things from abroad, down 4.5% year over year. Export prices as well, down 4.8%. Inflation is dead. This is what this is telling you here, is these year over year numbers are simply base effects. This one right here, 5.5%, are simply base effects. And you've seen this deceleration really since mid-June of last year, and you're going to continue to see this through the spring and into summer. And you could see a two handle probably by the third quarter at some point, maybe end of third quarter. I think the story of inflation is behind us, and that's why I titled this video that. So that was really the gist of this week, and why you had the market kind of chop sideways, and you had the move index. Look at the move index. This is reversing. I've talked about this. This is the volatility of the bond market, and anything above 150, that becomes a problem. You see this here back last year in the fall, and the Fed kind of pivoted behind the scenes, and there was some behind the scenes work with global central banks to improve liquidity, and they did that. And then you obviously had the banking crisis that also caused more volatility, but that's reversed. And as long as this stays well below 150, I think you're in good shape for risk assets overall. So I wanted to start off with that. Now the S&P down 8 points yesterday, but this is just consolidation. You're in a choppy sideways trading range, and that's what I kind of expect, because the market's going to start to pivot. The narrative is going to have to pivot towards what's going to happen with the economy as a whole. You saw the poor jobs number last week, or not to say poor, but yeah, it wasn't great, that's for sure. But you're not seeing, a whole lot of fallout in the credit markets, and that's also something I'm watching here. Is the SHYG, so short-term junk bonds to short-term treasuries. And if this is on the rise, you're fine. And this is one of the reasons why we weren't too bearish back in October when everybody's sentiment got really bad, was because you were making higher highs here. And you continue to make, higher lows. You're not making much higher highs, just kind of chopping sideways. But you remain in this range. Now, if it stays in this range for a longer period of time, that's not great longer term, because eventually it probably will break down. But you're here, and you could stay in this choppy trading range for a while, and that means the credit markets are holding in there, and that's what's important. That move index certainly skyrocketing was not good for the bond market as a whole. Corporations weren't out there borrowing much. I talked yesterday on the show about how there wasn't a lot of issuance of new credit, new corporate bonds over the past, over the couple, 2, 3 weeks during that crisis time during the banking crisis recently, and that was all because of just the movement in the Treasury and the you see the 10-year, with all this volatility in here, up and down moves. See this? See these up and down moves? That was not something the market liked. Um, but recently you've had a lot more issuance, and you see the 10-year kind of calming down in volatility and staying in this kind of low trading range, 3.5 to 4. I think that's kind of the range we're probably going to be in for a little while until the market figures out, when will the true pivot be? I think that's the next question. We go over to let's pull up the CME real quick. Just pivot back over here. And what you can see is the market's still pricing in a Fed rate hike for next month. I think it would be foolish for them to do that, but hey, that's only a few weeks away, and the market has a 78% chance of another rate hike. June, that is 66% chance of a pause right there. So really one hike and done, and then eventually you're going to talk about a rate cut. You start getting in here, 35% chance of cutting by July, and a 22% chance that will be lower on the Fed funds rate by September. And remember, these are just odds. These things change, but it is indicative of, remember, the yield curve, right? We talked about the yield curve inverting and that being a harbinger of things to come, and that was what was happening with the banking crisis. They raise rates. You do QT. You're going to start breaking things. In the fall, it was the markets of Japan and Great Britain, and they pivoted slightly. Recently you had the banking crisis. They pivoted with their new facility to try to support that market. If they keep raising rates, keep doing QT, they're going to break more things, and that's what the market's kind of pricing in, is that they're going to break something. It's just more of a matter of when. But in the meanwhile, the fact that they have pivoted again, kind of behind the scenes a little bit, providing liquidity, expanding their balance sheet, that has helped risk assets, and risk assets could continue higher for some time, and I think that's most likely. That breakage could be next year after, and so don't get too tied into a bearish sentiment just because we had a banking crisis. In fact, I think that was an impetus for a more accommodative Fed. Let's pivot over to the growth side of the market versus value. You've had, over the past few weeks, value start to outperform once again. And a lot of that has to do with the energy space. You're getting a nice move higher here on the XLE. And this was why, I've been saying, you want to buy the dips in energy for the most part, because this is a broad uptrend. Yeah, you've had a pullback, but this is kind of a choppy period still making higher highs, higher lows, in the midst of a strong dollar, right, over that time period. As of late, you've gotten a bit of a tailwind with a weaker dollar, and that's certainly helping this sector overall. And I think the dollar is probably going to be in more of a downtrend. Basic materials, you're starting to get some strength. I would like to see more out of this, but so far in decent shape after this bounce. The GDX gold miners making a higher high here, right? This is now an uptrend. This is a clear uptrend, overbought for sure, into some resistance. You can see this. This is a resistance point here. When you have this breakdown, this is going to be resistance. Okay, we trimmed, rebalanced a position or two in the gold space on Thursday when it hit this line. So it would not be shocking to see this be consolidating, but I do think eventually it will move higher. Gold also doing a consolidation dance here near the highs, and I think it will likely also break out as rates kind of stay muted. And I think we have seen rates peak for this recent cycle. I'll pull this back here. Here's a quarterly chart of the 10-year. talk about this long downtrend in interest rates and then this recent breakout over the past couple of years. And what you can see here is you hit that 2-5 retrace and found that resistance and entered a consolidation period. And I think that's what you get. And this consolidation period could last number of years. Remember, this is a quarterly chart, so you're talking about could chop sideways for 5-10 quarters before a final breakout up to this 382, which I do think we eventually get at some point. But and a lot of that's going to have to do with inflation. And inflation is likely to stay sticky higher. Yes, I talked about the recent inflation narrative is dead, and a lot of it has to do with these strong moves up in rates. But you've seen what's happening kind of with the dollar, with energy prices, with what's happening in Saudi Arabia, right? OPEC cutting their production. That's all the geopolitical winds are creating an inflationary environment. So I just wanted to give you my kind of bigger long-term perspective there. But it doesn't mean you can't get rates kind of chopping sideways. Doesn't mean you can't get inflation being lower for a little bit of time before ultimately, heading higher probably the next few years. VIX, the VIX down to 17, also good for risk assets. You can't be really mad about that. Let's look at CMBS. This is really where the credit problems are going to lie. Commercial mortgage-backed securities, you're getting this get a rally too as well. So the commercial mortgage market not falling apart, and a lot has to do with the banks kind of calming down. Right, here's the KBE that's calming down, getting a bit of it's stabilizing. This is bearish consolidation, so you don't really want to be jumping in front of the banks here. But the commercial mortgage market not falling apart at the current time. All right, let's look at the overall junk market. We talked about SHYG to the SHY. This is junk market to IEF, so this is more longer term bonds also holding in there as well. Let's see what else. Let's go to the transportation index. That's holding in there, right? Higher highs, higher lows in an uptrend. It's a sloppy uptrend. It's not a powerful one, and I think that's kind of what you're expecting here. Is it? We're not going to get the powerful uptrends of the market where there was tons of liquidity coming in back here, right? Look at this powerful uptrend from the COVID lows, right? Just tons of liquidity being thrown at the market. And then that turned, and obviously the market had a reversal. I mean, you're getting an improving liquidity environment, but you're not getting QE. You're not getting, the government going out there and spending a drastic amount of money over a short period of time. Yes, the deficit is increasing. Yes, that's going to be kind of a tailwind to inflation. I think is steady higher fiscal deficits. That's going to be probably something that you want to pay attention to and going to be a driver of that inflation longer term. But it's not something that you worry about right now. Really, we're in an improving liquidity environment, but still a low liquidity environment. Okay, and therefore, this uptrend is going to be choppy, not very powerful, not very exciting, but that's what you're likely to see. All right. Well, I want to thank you all for tuning in. That's my sentiment for right now. Neutral to bullish over the short term, medium term, but expect choppiness. Expect pullbacks like you saw in December, in February and March. Would not be shocked to see that again. Right, make another higher low, but that's kind of where you're at. All right. Thank you all for tuning in. A reminder that the contents of the video are for educational purposes only. It should not be considered as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a good weekend.